So is the story of Florida's real estate boom taking a really dramatic turn? That's the big question, isn't it? The central kind of provocative question that's posed by the source material you shared with us for this deep dive.
Yeah, definitely is.
It paints this picture suggesting cities that were, just recently surging with growth and investment are now showing some really undeniable signs of strain, potentially even heading towards feeling like ghost towns in certain spots.
It's a really compelling narrative in the information you sent over. And we're not just talking about like a general slowdown. The source, it specifically highlights data points and trends in 10 Florida cities.
Right, 10 specific cities.
Exactly. And it argues these mirror warning signs we saw before, in previous market corrections, but maybe amplified this time by some unique pressures that Florida's facing today.
Absolutely. So our mission here in this deep dive is really to unpack that specific source material, the one you provided. We're going to try and meticulously go through the insights it offers on these 10 particular cities. Look at the data points, the trends it presents.
Yeah, break it down.
And really try to understand the granular story your information is telling us. What's happening on the ground in these markets right now in 2025, according to this source? What exactly does it suggest is going on? And what could that mean, maybe, for the broader Florida housing landscape?
Well, think of us as guides, sort of through the information you've pulled together for us. We're distilling the critical insights, maybe some surprising facts buried in the source's analysis, giving you a shortcut maybe to understanding its perspective on how things are unfolding.
Okay.
We're basically exploring the concerns and the data points it highlights, the things that underpin this idea of vulnerability, maybe even distress in certain parts of the Florida market.
Okay, right. Let's unpack this then. The source, it structures its findings as a countdown, right? Identifying 10 cities that it sees as flashing serious warning signs.
Yeah, a countdown.
And it explicitly draws parallels to signals observed before the 2008 housing crash, suggesting that maybe, in some ways, the dynamics playing out this time could hit certain areas even harder.
That's a pretty bold claim it makes.
It is. And the source gives specific data points for each city to back that up. So we're going to walk through them one by one, starting with the city it lists at number 10.
Okay. And just a crucial point before we jump in. Our entire discussion, all the analysis here, it's based only on the perspective, the data, the arguments presented in the source material you shared.
Right. Good clarification. We're interpreting and elaborating its view,
Right.
what it sees as the warning signs.
Exactly. It's perspective.
Okay. So kicking off your countdown at number 10, the source points to Port Charlotte.
Port Charlotte, right. The source, it reflects on its recent past, describes it as having been like an underrated hidden gem around 2022.
A hidden gem. Okay.
Yeah, it had that appeal, Coastal breezes, homes were still relatively affordable compared to the big metros, and it seemed to offer a balanced lifestyle enough going on, but without that big city chaos. The median home price there, according to the source, hit $333,242 back then.
Paints a nice picture just a couple of years ago. But the source's view of the current state here in 2025, well, it sounds starkly different.
Very different.
It describes a very different vibe. Claims you can almost see the problem driving around houses just sitting and sitting and sitting.
Yeah, that visual is powerful. And the data your source provides, it tries to quantify that feeling. The first key warning sign it points to in Port Charlotte, a dramatic increase in days on market.
Right. How long houses are taking to sell.
Exactly. Homes that, according to the source, would maybe sell in about a week, maybe two, back during that peak demand. They're now reportedly lingering for 90-plus days.
90 days. Wow.
Yeah, this isn't just like a slight cooling off. The source suggests this is a fundamental shift, a real change in the speed and the health of the market. It indicates a big drop-off in buyer urgency, less activity.
And when homes sit longer, especially after prices went up so fast, well, that often leads to the next issue the source brings up. A pretty serious price plunge.
Exactly right. The source states the median price in Port Charlotte has dropped now to $285,719.
Okay, let's break that down.
So that's a decrease of 47,523 peaks from that 2022 peak we mentioned. In percentage terms, according to the source, that's a 14.2% decrease.
14.2%. That's significant.
It really is, especially for anyone who bought during that crazy pandemic boom, maybe late 2021 or early 2022. That kind of rapid depreciation, it can be devastating. It means their equity is just eroding fast or maybe completely wiped out.
Which brings us right to the next big concern the source identifies. The early signs of a negative equity crisis. Yeah. Being underwater, right?
Precisely. If you bought with a relatively low down payment when prices were sky high, a 14.2% drop, that can easily mean you now owe more on your mortgage than your home is actually worth on the market.
Yeah,
And the source suggests this is becoming a reality for some homeowners there in Port Charlotte.
that's a tough spot to be in. Really limits your options.
Absolutely. Being underwater, it's stressful, limits your ability to sell without taking a loss, can't really refinance easily, and it increases the risk of default if, some financial hardship comes along.
Hmm.
And compounding this, the source points to a significant supply glut. They claim builders were really active in Port Charlotte during the boom, especially in newer neighborhoods. They were expecting demand to just keep rising.
But it didn't.
According to the source, that demand dried up fast, leaving apparently entire rows of brand new unsold homes just sitting there.
So they built for a market that basically vanished.
That's the picture the source paints, yeah. They even mentioned some construction projects being canceled mid-construction. Builders reportedly just halting work because maybe financing got tight, or the market outlook just completely soured.
It's a bad sign. When builders stop building.
It's a clear signal, they argue, that the expected growth just isn't panning out.
And then, like throwing fuel on the fire, the source highlights this massive, insane spike in insurance.
Yeah, this is presented as a really critical factor. Your source claims some local homeowners in Port Charlotte are now facing annual insurance premiums of like $7,000, $9,000, maybe even more.
Annually. Just for insurance.
Annually. And they point out in some cases, this annual insurance bill can actually be higher than the homeowner's total annual mortgage payment, principal and interest combined.
Wow. How can people afford that?
Well, that's the point. When the cost of insuring the home rivals or even exceeds the cost of paying for the home month to month, the overall financial burden just becomes incredibly difficult, maybe impossible, for many families to sustain.
That kind of unexpected, huge recurring cost would definitely push people to the edge.
It fundamentally changes the whole affordability calculation. And the source suggests the combined result of all these pressures, falling prices, oversupply, those punishing insurance costs, it's leading to a visible population decline.
Wait, we're leaving.
According to the source, yeah. People are making that tough call, packing up and leaving Port Charlotte because the math just doesn't work anymore. The cost versus income or the declining value of their property, it's not sustainable. They describe it as a slow but real decline.
And that decline probably makes the market even weaker, right? Fewer potential buyers or renters.
Exactly. It creates a feedback loop. So the source's analysis for Port Charlotte, it's not just one thing. It's how these multiple negative factors, the crazy insurance, the sharp price drop, the leftover supply from overbuilding, and the resulting population outflow are all feeding off each other.
Creating this negative cycle.
Right. They suggest this combination is what gives the area that feeling of a ghost town in the making. And for the market to stabilize, the underlying financial fundamentals presented in their data, they'd need a huge and probably unlikely shift.
It's that mix of financial burdens pushing people out and too much supply from speculative building that paints the grim picture in the source's view.
That's the core of their argument for Port Charlotte, yeah.
Okay, let's move down their list. Number 9, they highlight Cape Coral.
Cape Coral. The source describes this one as, like, the golden child of the Florida housing boom back in, say, 2021, 2022.
The golden child.
Yeah, super popular. High demand from everyone, investors, retirees, remote workers wanting that waterfront lifestyle. And all that demand pushed prices way up. Hit a peak median of $424,767 in 2022, according to the source.
A real boomtown story just a little while ago.
Yeah.
But their take on 2025, not so golden.
No, they state pretty clearly the boom there is fizzling out hard. The median price dropped significantly, down to $361,761 now.
Okay, so that's a drop of...
Let's see, $63,000 from that peak value mentioned. Percentage-wise, it's nearly 15% down. And your source notes, while that's the overall median, some specific neighborhoods within Cape Coral, they've seen even bigger dips.
15%. So what's driving that rapid cooling, according to them?
A major factor the source identifies is a big investor sell-off.
Ah, okay. That makes sense. For Cape Coral, it was huge with investors. If the market turns, they would want out fast.
Exactly. The source claims a big chunk of the current listings, they estimate over 25%, are owned by investors or flippers who are actively trying to bail out before values drop even more.
Over a quarter of listings are investors trying to sell.
That's what the source claims. And this rush by investors to unload properties, it creates a domino effect, the source argues. When investors start slashing prices to get buyers and get out, it pressures everyone else, regular homeowners, other sellers, to lower their prices too, just to compete.
More sellers rushing for the exits means way more homes for sale.
Precisely. The source points to exploding housing inventory. The number of available homes on the market in Cape Coral, based on the data you shared, has nearly doubled in just the last 12 months.
Doubled in a year.
Yeah. They point specifically to those newer developments that, as the source puts it, kind of popped up like mushrooms during the peak. Builders clearly thought that intense buyer demand from 21-22 would just keep going. But the source claims buyer interest really faded, leaving all that new supply sitting there.
So twice as many homes available, fewer buyers showing up. It's inevitable homes would start sitting longer on the market then.
Right. Buyers now have way more choice, feel less pressure to jump immediately, so homes linger longer before selling, which just adds more downward pressure on prices as sellers get anxious. And just like Port Charlotte, that issue of soaring insurance premiums is huge here, maybe even worse because of Hurricane Ian back in late 2022. Your source says after Ian, rates for a lot of homeowners just went wild.
How wild? What kind of numbers are they talking about?
The source claims some homeowners in Cape Coral are now paying annual insurance premiums between $6,000 and $10,000, maybe even higher.
$6,000 to $10,000 a year.
Yeah. They emphasize this is like paying a second mortgage for many residents. It just pushes the total cost of owning a home beyond what's feasible for more and more people. It's a direct, major hit to affordability, made much worse by the insurance market chaos after the hurricane.
That completely changes the math for owning a home there.
It really does. And beyond listings and prices, the source points to other signs, like deals struggling to close. They note that pending sales are falling through at record rates in Cape Coral, apparently.
Deals falling apart before closing.
Yeah. And they also mentioned builders are quietly canceling or pausing projects. Those are real, tangible signs that market confidence among developers has just eroded.
So the source's take on Cape Coral really stresses those specific factors, the big investor presence and the really punishing post-hurricane insurance hikes as key drivers there. It's that combination, they suggest, that's quickly turning what was a tropical dream market into more of a caution zone.
That's the core argument in your source. These distinct pressures, layered on the general market shift, are really shaping Cape Coral's downward trajectory right now.
All right, number 8 on their list, Northport.
Northport. Yeah, your source highlights this one as maybe the ultimate poster child of that Florida pandemic migration boom.
Poster child, how so?
Well, it saw this massive influx, remote workers, retirees, families looking for more space, maybe perceived affordability outside the big metros. All that rapid growth and demand drove home prices up incredibly fast. In 2022, the median price there, according to the source, hit a jaw-dropping $379,254, made it one of the fastest-growing markets in the state back then.
Jaw-dropping growth, okay. But their view in 2025 shows a big reversal. Those same homes, they say, are now selling typically for around $321,224.
Yeah, that's a substantial drop, $58,000 from the 2022 peak, about 15.3% less. The source sees this not just as a minor correction, but part of a deeper unwinding of those pandemic boom excesses.
Okay.
And one major issue, which sounds familiar from other cities on this list, is a pronounced supply glut.
Overbuilding again. Seems to be a recurring theme in your source's analysis.
According to the source, it was definitely the case in Northport. They say builders rushed in to meet that perceived demand, and entire subdivisions sprang up seemingly overnight.
Wow.
But just like other areas, the source claims buyer interest just didn't keep up with all that frantic building. Left many of those new homes sitting empty. Signs for new builds collecting dust. The source points to that as a visible symptom of oversupply, really outpacing buyer demand.
And that oversupply leads to falling prices.
Directly. Leads to falling prices as sellers compete for fewer buyers. Creates an environment, the source says, of panicked sellers.
And that panic is probably made worse by the next warning sign they mentioned. Pending sales collapsing.
Absolutely. The source describes pending sales in Northport as falling through left and right. Calls getting financing a nightmare for buyers.
Why a nightmare? What are the reasons?
Well, the source cites lenders significantly tightening their standards. Higher down payments needed, stricter credit scores, fewer flexible loan options. This basically sidelines a lot of potential buyers who might have qualified just a year or two ago.
Okay.
And the source gives a really striking statistic for this. Over 30% of pending deals in Northport reportedly collapsed in the last quarter alone.
30%. That's huge.
Yeah, they describe it as huge too. Indicative of serious market dysfunction, they argue, shows just how hard it is for deals to actually close in this environment, according to the source. Signals widespread problems with buyer qualification or maybe just market confidence leading to cold feet.
Yeah, definitely indicates fragility.
And another concerning sign the source points to is a noticeable increase in rising foreclosure rates. They claim homeowners who bought at the peak, maybe with less favorable terms or higher loan amounts, are now struggling with payments, especially if they're also facing unexpected hikes in property taxes, insurance, or those rising HOA fees.
Hmm.
The source states foreclosure filings in Northport spiked over 60% year over year. That's presented as a significant red flag, indicating real financial distress among homeowners.
60% jump in foreclosures.
Yeah,
That adds another layer of potential supply hitting the market, often at lower prices too.
precisely. And with more homes available new builds, potentially foreclosures and deals struggling to close, the days on market have predictably shot up. The source says it now takes over 90 days on average to sell a house in Northport, up from around 30 days in 2022. And they note it's still climbing, ongoing stagnation.
Over 90 days.
Yeah.
So the source's analysis for Northport really emphasizes that potent mix. Builders severely overestimating demand, leading to this overhang of supply, tighter financing blocking buyers from closing deals, and clear signs of financial distress with rising foreclosures.
Right.
They suggest that while Northport might not look like a ghost town yet, these trends, if they continue like this source presents, paint a really concerning picture for its future market health.
It's that specific combination, excessive past growth, current financing problems, and increasing homeowner distress that the source argues makes Northport particularly vulnerable.
Moving on, number 7 on their list, Palm Bay.
Palm Bay. According to the source, this one was maybe a bit more under the radar during the peak compared to some others, known mostly as a place for more affordable homes on the East Coast. Back in 2022, the median home value was listed at $328,357, made it attractive for budget-conscious Floridians, as the source puts it.
And in 2025, the source notes the price dipped to $312,342. That's a $15,015 slide. Your source points out that this isn't the biggest percentage drop on their list, about 4.6%.
That's right. The source acknowledges that on the surface, the percentage drop isn't as dramatic as some others, but they argue pretty forcefully that this is just the tip of the iceberg, claiming there's hidden rot underneath the surface that makes the situation serious.
Hidden rot. What are they pointing to?
Well, the first unique issue they highlight in Palm Bay is a notable Airbnb owner exit.
So investors buying specifically for short-term rentals were a big factor there, like Airbnb, VRBO.
According to the source, yes. They claim many investors bought properties in Palm Bay during the boom, specifically intending to run short-term rentals. But then new local regulations came in, plus the market got oversaturated in 2023-2024, led to a big pullback.
Right.
The source states many of these hosts are now dumping their properties. Finding the business just isn't profitable anymore, or maybe too restricted.
And that creates a flood of investor listings, adding unexpected supply, right?
Exactly. The source argues this influx of listings, specifically from these short-term rental investors, is throwing off the market balance, adding downward pressure on prices.
Okay. What else is part of this hidden rot?
Another major sort of fundamental point your source makes about Palm Bay's market is a significant price-to-rent ratio imbalance. They note typical rents are around, say, $1,700 a month, while many homes are still listed for well over $300,000.
Why is that ratio so important? Explain that a bit.
Well, the source argues this math just doesn't work for new buyers or investors, especially with current mortgage rates up around 7–8%. When you compare the monthly cost of renting $1,700 to the monthly cost of owning a $300,000 plus home with a high interest rate, including mortgage, insurance, taxes, maybe HOA fees, owning is significantly more expensive than renting.
I see.
The source claims this financial gap makes renting the clearly smarter option for many, which fundamentally undermines demand for buying homes.
So the affordability factor, which was Palm Bay's main draw, is getting squeezed not just by rising costs, but by this disconnect between purchase prices and what you can rent for.
That's the source's argument, yeah. They say this imbalance, plus other factors, has caused buyer demand to tank. They also repeat that buyer financing issues are worsening, similar to other cities. The source claims many working-class families, a big part of the potential buyer pool in Palm Bay, just can't qualify for mortgages now with the stricter lending standards, leaves more properties just sitting.
Which means the days on market are increasing there too, I assume.
Yes. According to the source, the average home in Palm Bay now takes over 85 days to sell. That's a big jump from only 30 days in 2022. They explicitly link this to fewer buyers, tougher loans, more stagnation.
Hmm.
And interestingly, the source notes something specific about Palm Bay's rental market. Unlike some areas where rents might still be strong, they claim to see rental market weakness. Rents plateauing, or landlords reportedly slashing prices, offering deals like a free month just to fill empty units.
So even the rental side is softening.
The source sees that as another signal the whole housing ecosystem, including rentals, is cooling rapidly there.
So the source's analysis suggests that while the headline price drop might seem smaller, these specific underlying issues, the Airbnb investor exodus, that fundamental price-to-rent imbalance, are key vulnerabilities driving Palm Bay's problems.
Right.
They argue these factors show the market foundation's cracking, even if the surface numbers don't look quite as dramatic yet.
They definitely view those specific dynamics as particularly concerning signs of deeper instability in Palm Bay's market based on their data.
Let's move to number 6 on their countdown, Port St. Lucie.
Port St. Lucie. Described by the source as having been a very appealing, family-friendly city. Seen as safe, clean, grew very fast leading up to 2022. All that rapid growth pushed home prices up significantly. Median reached $405,010 in 2022, according to the source.
And now, in 2025, the source says prices are sliding back down to $375,513. That's a drop of about $29,500, or just over 7%. The source acknowledges, yeah, on the surface, 7% drop doesn't look catastrophic.
True. Compared to some others on the list, that percentage seems more moderate. But the source argues you look beneath the surface, and cracks are showing fast in Port St. Lucie's market health. The first big issue they identify a key driver of the boom, now reversed, is collapsing buyer demand.
Was a lot of their demand from out-of-state, people moving in?
According to the source, yes. They state that interest and relocation from out-of-state buyers, which really fueled Port St. Lucie's rapid pandemic boom, has significantly dried up.
Why? Any reasons given?
They attribute it to higher mortgage rates, making moving more expensive everywhere, and maybe just fewer people choosing to relocate to Florida now compared to those peak years. This, the source argues, means the once red-hot bidding wars are a thing of the past. Now they say sellers have to offer concessions, contributions to closing costs, rate buy-downs, simple price cuts just to get any serious buyer interest.
So the engine of demand that drove the boom has basically stalled out.
That's the picture the source paints.
Okay.
And this lack of strong demand, it's visibly impacting deals supposedly in progress. They point to a significant pending sales collapse.
How bad?
The source claims nearly 1 in 3 pending sales in Port St. Lucie fell through last year.
1 in 3. Wow.
Yeah. They cite various reasons. Buyers failing to get financing under tighter rules, low appraisals coming in below the agreed price.
Right, the appraisal gap.
Leaving buyers short on loan funds, or just buyers getting cold feet facing the high costs or the uncertain market. They call this a clear sign of a shaky market, lack of buyer confidence or ability to close.
1 in 3 deals failing.
Yeah.
Yeah, that shows real fragility, according to the source.
It does. Another significant pressure point the source highlights in Port St. Lucie is surging HOA fees, especially in those newer developments that saw so much building.
Okay, what's driving those up?
They claim costs for things like community insurance policies, maintaining amenities, necessary storm upgrades.
Yeah.
They've risen dramatically. The source gives examples of fees jumping from maybe $80 a month to over $200 a month.
That's a big jump.
Yeah. They argue this adds a significant, often unexpected, recurring cost burden. Residents are feeling the pinch, impacting overall affordability.
That rising recurring cost on top of mortgage, insurance, taxes makes ownership even harder.
Absolutely. Another piece of the puzzle, increasing the total housing cost. And reflecting the collapsing demand and deals failing, the days on market have increased. Maybe not as dramatically as some other cities on the list, but still noticeably.
How much?
The source notes homes were selling fast in 2022, around 24 days on average now. It's increased to over 65 days in 2025. So while homes aren't sitting for 90-plus days like elsewhere, the source describes this significant lengthening of the sales cycle as a blinking warning light for market health.
So the source's analysis for Port St. Lucie suggests that even though the percentage price drop seems manageable, it's the combination of that severe collapse in out-of-state buyer demand, the really high rate of pending sales failures, and the unexpected hit from surging HOA fees. Those are the big warning signs.
Right.
They imply these factors, maybe more than just the price dip itself, could signal the start of a potentially steeper slide down the road.
They see these specific pressures losing that strong demand engine, the HOA burden, as key vulnerabilities for Port St. Lucie's market moving forward based on the data they've analyzed.
Okay, we're halfway through the list provided by your source. Coming in at number 5, Poinciana.
Point Siena. Described by the source as a classic example of a once affordable suburban haven southwest of Kissimmee, it was popular for first-time buyers, working families, people looking for a place they could actually afford a home. In 2022, the median home price there hit $322,485.
But in 2025, the source claims that dream is cracking in Poinciana. Median price reportedly down to $290,655 now.
Yeah, that's a sharp decline. $31,830, or about 9.7% off the peak. The source argues this price drop is only part of the story, though. They point to what they call a big red flag in Poinciana, the phenomenon of insurance exceeding mortgage payments.
Wait, again, the monthly insurance bill is higher than the payment for the actual loan.
That's precisely what the source claims is happening for some homeowners in Poinciana, especially if they're in zones considered higher risk for flood or storm damage. They state some residents face monthly insurance bills of $500 to $800.
$500 to $800 a month just for insurance.
That's the claim. And if their principal and interest payment is lower than that, the source argues, insurance becomes their single biggest housing expense. When that happens, the source notes bluntly, it's no wonder people are walking away from their homes.
That level of unexpected, crippling cost,
Yeah.
it makes homeownership unsustainable for many families, especially those who are budget conscious to begin with.
It fundamentally breaks the financial model of ownership for a lot of people, according to the source. And they link this to a rental market weakness domino effect. Investors who bought properties in Poinciana to rent out, they're reportedly finding it harder to profit.
Why is that?
The source claims rents haven't kept up with the soaring ownership costs, especially insurance. Vacancies are reportedly creeping up, so landlords are offering incentives, first month free, dropping prices just to fill units. The source sees this as a direct result of high ownership costs making renting relatively cheaper and more attractive, softening rental demand.
So the high costs hurt both owners and investors, makes neither buying nor investing very appealing.
Right. The source also points to declining property tax assessments as a rare but telling sign of distress in Poinciana's market.
Meaning the county is officially saying values are down.
Essentially, yes. They report local governments are starting to adjust property tax rolls downwards because official appraisers are acknowledging the sliding home values. The source interprets this as a clear official signal the market isn't just slowing, it's actively retreating. Even the local government revenue projections are starting to reflect what's happening.
That's a pretty stark indicator when the official tax base is adjusted down because values are falling.
It provides official confirmation of the trend. Another issue hitting homeowners hard, according to the source, massive special assessments.
Special assessments, what are those for?
The source claims some homeowners associations, HOAs, in Poinciana are levying these big one-time assessments, often thousands of dollars per homeowner to cover major costs. Things like post-storm repairs or infrastructure upgrades that weren't adequately funded or insured. The source says these unexpected bills hit homeowners like a truck, leaving them scrambling for cash or risking an HOA lien on their property.
That's another huge unplanned expense on top of rising regular costs. Ouch.
Precisely. As yet another layer of financial pressure. Compounding all this, days on market are climbing. Average home now reportedly takes over 70 days to sell. Many sit much longer. And finally, the source points to population growth slowing, maybe even reversing.
Keep believing again.
They claim families are being priced out by the combined costs, and some subdivisions are reportedly getting eerily quiet as residents move elsewhere for more affordable options.
So the source's analysis for Poinciana really focuses on that cumulative impact of extreme financial pressures, insurance, higher than mortgages, huge special assessments, declining tax values, fundamentally wrecking the affordability that was the city's main draw.
Yeah.
They conclude these multiple severe indicators mean signs of decay are mounting in Poinciana's housing market.
It's the layering of those distinct financial burdens hitting homeowners from multiple angles that the source views as particularly concerning for Poinciana.
All right, number 4 on their list, Deltona.
Deltona. Described by your source as having been a quiet, sort of low-key suburb, Conveniently located between Orlando, the Atlantic beaches, Daytona, its appeal was mainly offering more affordable housing compared to its busier neighbors. Back in 2022, the average home sold for $340,178.
And in 2025, the source claims that number has plunged significantly, down to $298,655.
Yeah, that's a sharp loss. $41,523 from the 2022 average represents roughly a 12.2% decline, according to the source's data. And the source identifies a major factor fueling this slide that's directly tied to cost of living, population decline.
So similar to Port Charlotte or Poinciana, people are leaving because it's just gotten too expensive.
That's the connection the source makes, yes. They claim the very families attracted to Deltona for affordability are now leaving because the overall cost of staying no longer makes sense. These rising costs include, according to the source, ballooning insurance premiums, claiming they've passed $6,000 a year for many homeowners, and notably jumping HOA fees, reportedly up by 40% or more in many subdivisions.
So if costs are driving people out, that naturally shrinks the pool of potential buyers.
Exactly. The source directly links that shrinking population and the high ownership cost to a visible collapsing buyer demand. They offer a pretty striking anecdote. Homes in Deltona that got multiple offers during the peak, now reportedly sitting with 0 showings for weeks.
0 showings for weeks. That's a dramatic turnaround.
It really illustrates the sudden disappearance of buyer interest. And reflecting this lack of activity, the days on market for homes in Deltona have, according to the source, basically doubled, from around 30 days in 2022 to over 75 days now.
Doubled.
The source describes this not just as a slowdown, but calls it a full-blown stall in market activity. They also note a significant investor sell-off happening here, too.
Investors heading for the exits here as well.
The source claims many investors who'd scooped up properties in Deltona for rental income are now pulling the plug, flooding the market with their listings. This adds even more inventory into an already stalled market, creates that cycle. More homes for sale, fewer buyers, more pressure on sellers to cut prices.
And I assume pending sales are also struggling to close here.
Yes. The source mentions pending sales are falling through at a high rate in Deltona. Reports 1 in 4 deals failed to close in Q1 2025. They point to the usual suspects: buyer financing issues, low appraisals, general buyer nerves about the uncertain market. The source's overall assessment is that Deltona's housing market is on shaky legs.
So the source connects the population decline directly to rising costs, especially insurance and HOAs. And that outflow, combined with broader factors, fuels collapsing demand and market stagnation. They suggest that despite maybe looking like a quiet suburb, the underlying market data tells a story of serious decline.
It's that clear causal link the source draws: affordability erodes, residents leave, demand disappears, that forms the core of their concern for Deltona.
Okay, coming down to the top 3 on their list now. And number 3, Ocala.
Ocala, located more inland, described by your source as representing Florida's rural escape dream. The appeal was wide open spaces, horse farms, and the promise of more affordable homes compared to coastal or major metro areas. In 2022, the median home price reflected that, sitting at $280,110.
But in 2025, the source claims that rural escape dream is hitting serious potholes. Median price reportedly dropped to $255,590.
Yeah, that's a dip of $24,520 from the peak, almost 9% off the 2022 high. The source acknowledges this percentage drop alone might not sound apocalyptic compared to some others,
Right.
but they argue forcefully the surrounding symptoms make the Ocala situation particularly serious. The single biggest issue they identify, and they really emphasize its severity here, is soaring insurance premiums.
This seems to be a statewide problem, but is it especially bad in Ocala, according to the source?
According to the source, yes. It's presented as a massive issue specifically in Ocala and surrounding Marion County. They claim homeowners are seeing annual policy costs double, even triple, in just a couple of years. A typical $2,000 annual premium in 2022, now reportedly topping $5,500, $6,000, maybe more.
Wow, that's a huge jump.
Yeah, and the source notes this particularly hits owners of older homes or properties outside city limits, common in a more rural area like Ocala. This dramatic increase, they argue, pushes the total monthly cost of ownership way beyond affordability for a lot of the local population.
That soaring insurance cost just completely undermines the affordability that was Ocala's main draw, doesn't it?
Absolutely. Negates a core reason people moved there. Another worrying sign the source highlights is canceled construction projects. They call this a subtle yet deadly market signal.
Meaning builders are pulling back.
Yeah. Builders who saw Ocala as the next boom town during the peak are reportedly slamming on the brakes on new construction. The source claims multiple new communities paused midway, leaving visible signs like empty lots where homes should be, half-built houses scattered around the outskirts.
So not only are existing homeowners struggling with costs, but the picture for future growth looks dim, according to the source.
That's the conclusion they draw from seeing developers halt activity. Reflecting the overall lack of buyer activity, skyrocketing days on market are also a major factor. Homes that sold like hotcakes in 2022, according to the source, now sit for 80-plus days, and that number is reportedly still rising. The source suggests buyers are hesitant, maybe waiting for more price drops, while anxious sellers are increasingly cutting prices, offering incentives to try and move properties.
And another familiar red flag popping up here: declining property tax assessments.
Yes, the source calls this a major red flag for Ocala. They state local property tax rolls are being adjusted downwards as official county appraisers recognize and formalize the sliding market values. The source interprets this as concrete evidence that even the local government sees what's happening and has to adjust revenue projections based on falling property values.
So the source's analysis for Ocala stresses that combination: extreme insurance hikes hitting rural older homes hard, plus canceled new construction. Paints a picture of existing homeowners struggling and future growth prospects dimming. The rural charm's still there, they argue, but the financial foundation is buckling.
They see that unique blend, the severity of insurance costs plus halted development, as particularly concerning for Ocala's market trajectory, based on the data they've presented.
Coming in hot at number 2, their list includes a major metropolitan area, Tampa.
Tampa. Yeah, the source describes it as the undeniable rock star of Florida real estate in the early 2020s. Fast job growth, booming economy, just a dynamic, desirable place to live, led to strong housing demand. Average home cost, according to the source, hit $383,410 in 2022.
As a major metro, a shift in Tampa's market feels especially significant compared to some smaller cities. Your source says the average price dipped to $360,135 in 2025.
Yeah, that's a slide of $23,275 from the 2022 peak. The source notes that while this percentage drop might not sound huge for a high-value metro, they argue it raises serious eyebrows precisely because it's a big reversal in an area with such strong prior momentum.
Okay, what's the biggest warning sign they see there?
The single red flag waving hardest for Tampa, according to the source's data, is exploding housing inventory.
How much has inventory increased?
The source gives a really stark statistic. Active listings in the Tampa metro, by their analysis, jumped over 55% since last year alone.
55% increase in available homes.
Yeah.
In just 1 year. In a major metro, that is a massive shift in supply and demand.
It indicates a huge wave of homes hitting the market just as buyer activity cools. Properties that, according to the source, sold in under 2 weeks during the boom, now reportedly sitting for 75 to 90 days.
Wow.
And the source notes press cuts are becoming common. Reductions of $10,000, $20,000 becoming the norm for sellers trying to stand out in this crowded market.
And with mortgage rates still up there, around 7.5% as cited by the source, it's not surprising that buyer financing issues are a big factor.
The source states many potential buyers, especially first-timers who might have stretched with lower rates, are now priced out or just rejected for loans under stricter standards. This difficulty getting financing directly contributes to a sharp fall in pending sales.
How much have pending sales dropped?
According to the source's data, pending sales in Tampa were down 28% in Q1 2025 compared to the previous year. They call this a scary stat, specifically for a city like Tampa that relied heavily on fast closings and investor activity during its boom.
And are we seeing the investor sell-off trend hitting Tampa too?
Yes, the source mentions it as a contributing factor, especially in areas popular for short-term rentals. They claim Airbnb hosts are bailing in certain Tampa neighborhoods as the economics get less favorable, regulations, saturation, or just the cost of carrying properties in a less liquid market. They also note long-term landlords in Tampa are reportedly struggling to break even, vacant rentals piling up, adding more supply pressure.
So the source frames Tampa's situation not quite as a potential ghost town like some smaller cities, but as a significant, maybe concerning due to its scale, housing correction in a major metro.
Right.
The sheer speed and size of that inventory jump, plus the drop in pending sales and investor retreat. It suggests the intense heat wave in the Tampa market is definitely over, according to their view.
They see that rapid, large-scale reversal of key metrics in a major dynamic market like Tampa as a particularly noteworthy development on their list of warning signs.
All right, according to the source material you provided, the top spot on their list, the city they see as potentially most vulnerable, showing the most concerning convergence of warning signs is Winter Haven.
Winter Haven, yeah. The source describes it as a cozy central Florida city that, during the boom, quietly grew into a favorite for people seeking a slightly different Florida lifestyle. Appeal included relatively affordable homes, lots of lakes for lakeside living, and distance from the Orlando chaos. In 2022, homes there averaged $300,205.
But in 2025, the source states that average has fallen significantly, down to $275,513. That's a drop of about $24,700, roughly 8.2% decline.
Yeah, and the source argues that in Winter Haven's case, it's not just prices falling. They claim it's the entire foundation shaking, stating the city is flashing multiple crash indicators very fast. The very first and arguably most severe indicator they list, once again, insurance premiums exceeding mortgage payments.
Like we heard in Poinciana, that's a critical affordability crisis.
Yes. The source claims some homeowners in Winter Haven face devastating monthly insurance bills, sometimes $600 to $800 just for insurance. They note it's particularly common near lakes or for older homes. The source emphasizes, for many residents, this monthly insurance cost is now higher than their principal and interest payment combined.
When insurance is your single biggest housing cost and it's that high, it's hard to see how families can possibly afford to stay.
It makes sustainable homeownership incredibly challenging for many, according to the source, and this direct financial pressure is linked to the next sign they highlight: population slowdown or even outflow.
People leaving Winter Haven, too.
The source claims, for the first time in decades, Winter Haven actually saw a net outflow of residents in 2024. People reportedly moving out, citing unaffordable living costs, the insurance nightmare. The source says this contributes to previously lively neighborhoods becoming eerily quiet.
So unlike some areas where growth just slowed, the source claims a net loss of residents, actively emptying parts of the city.
That's the specific and concerning trend the source identifies there. They also point to a significant supply glut in new developments. Builders, according to the source, went wild in 2021-2022, building frantically, betting heavily on continued demand. But that demand didn't materialize as expected. Now, the source claims many homes in these new subdivisions sit vacant.
And that oversupply puts huge pressure on the builders, right?
It does. The source notes builders in Winter Haven are now resorting to offering substantial builder incentives just to try and move inventory. They mention offers like $20,000 discounts, free upgrades, significant cash incentives. The source argues this is a clear sign of desperation from builders trying to unload properties that aren't selling.
Add to that the general difficulty buyers have with financing.
Yes, the source includes buyer backouts and financing crumbling as adding to the stagnation in Winter Haven. And just like in Poinciana, special assessments for storm damage repairs are reportedly hitting homeowners like a truck, adding thousands in unexpected bills on top of already soaring costs.
And finally, maybe the most extreme indicator the source mentions for Winter Haven: properties listed below 2020 prices.
That's correct. The source states market pressure has gotten so severe in some cases in Winter Haven that properties are listed for sale at prices lower than they would have commanded back in 2020 before the big pandemic boom even started.
Listing below pre-boom prices. Wow.
The source describes it as an extreme measure sellers are taking and just to try and attract any offers.
So the source's analysis positions Winter Haven as potentially ground zero for the most severe convergence of these warning signs. They highlight that mix of multiple acute indicators: insurance costs driving residents away, documented population decline, major oversupply forcing huge builder discounts, and properties hitting the market below values from 4 years ago.
It's that layering and intensity of multiple negative factors hitting existing homeowners and the new construction market at the same time that leads the source to identify Winter Haven as particularly vulnerable based on the data they've compiled.
Okay, let's just take a step back and synthesize this a bit. We've gone through the 10 cities your source specifically highlighted, looked at the particular data points and trends it presented for each. And while every city has its own unique mix of pressures, there are some undeniably clear common threads running through their analysis, wouldn't you say?
Absolutely. Looking across the source's findings for these 10 cities, several recurring issues really stand out as major drivers of the tough market conditions it describes. Rapidly rising insurance costs. That's mentioned in almost every case. Often highlighted as a crippling financial burden, sometimes even, as we heard, surpassing mortgage payments.
Yeah, that insurance piece is huge.
And there's that pervasive theme of supply gluts from overbuilding, where developers got really aggressive, built tons of new inventory based on peak demand projections that just didn't hold up.
Right. And that oversupply is directly linked to collapsing buyer demand. which the source ties to a few things. Higher mortgage rates making homes less affordable overall, plus the increased cost of ownership from insurance, HOAs, taxes. We also heard repeated mentions of investor sell-offs, adding more listings, especially from those short-term rental owners getting out.
Exactly. And a consistent signal of market weakness is that high rate of pending sales failing across many cities. Shows widespread difficulty closing deals, financing issues, appraisal gaps, buyer nerves. Coupled with that is the almost universal report of increasing days on market. Homes are just taking much, much longer to sell than they did during the boom. And in several cities, the source explicitly cited population decline or slowed growth, and those rising HOA fees or special assessments adding significant pressure.
So while your source focuses on these 10 specific cities and their data, the underlying reasons driving the pressure, that ongoing Florida insurance crisis, the impact of higher interest rates on affordability and sales volume, the basic imbalance from oversupply hitting just as demand cools, these feel like broader economic and market forces at play.
They are indeed larger trends, and that's why understanding these local examples, the specific data points your source provides, it can be really relevant to you, the listener. Regardless of whether you live in one of these exact cities,
Right.
these specific signals presented by the source, they could potentially be leading indicators for other areas that saw similar rapid growth recently. They highlight vulnerabilities that might exist in certain types of markets, like those heavily reliant on migration, or with older housing stock hit hard by insurance hikes, or areas with lots of speculative new construction. We've deliberately focused only on presenting and exploring the perspective, data, and warning signs highlighted in the source material you provided to pull out these core insights for you.
It really paints a detailed picture, though definitely a concerning one based on the source's analysis. It's clear from the information you shared that it's rarely just one single thing causing problems. It's usually a complex mix of pressures hitting different cities in slightly different ways. Maybe insurance is worse here, overbuilding there, investors leaving somewhere else, but often leading to similar outcomes. A much slower market, noticeable price drops from the peak, and homes just sitting unsold for a long time.
And the source's specific claims about this convergence of warning signs potentially leading to cities showing characteristics like ghost towns, quieter neighborhoods, empty homes, less activity, that's certainly a provocative trajectory they outlined.
So, based on the picture painted by the source material you shared, if these trends, the soaring ownership costs, falling demand, empty properties, deals falling apart, and in some cases, people actually starting to leave if they continue along the path the source suggests, what does that really imply about the long-term sustainability of the rapid growth these specific areas saw? Growth that, according to the source, was often fueled by intense migration and assumptions of continued low costs. What might the next chapter realistically look like for these communities based on the potential future outlined by your sources? Something for you to consider as you reflect on the information.